Okay, so intro. So we can just start going, right? So let's just get into it right now.
We're all in agreement.
Okay, guys, do you want to get started? You will own nothing and be happy. The Trump administration just announced the 50-year mortgage. This is all part of the WEF's plan, the Great Reset.
Or is it?
Bill Pulte of the Federal Housing Administration, along with the Trump administration, just proposed the 50-year mortgage, which the general sentiment has been crazy. People's hair is falling out. Not mine. It was already out before the making of this video. His too. But we actually have a different outlook on the 50-year mortgage.
Yeah, we actually believe that this 50-year mortgage could be a tool in your tool belt, depending on how you use it. It is definitely not the one-size-fits-all, but let's talk about that.
My name is Daniel Hopp. I have been selling real estate in Southern California for the past 10 years and really wanted to make this video for you today so that you can cut through the noise, and there is a lot of it out there, and understand why this may or may not be right for you.
Yeah, my name's Cody Fairfield. I'm a financial advisor, good friend and actually brother-in-law with Daniel here, and we thought it would be really useful to get together, put our industry knowledge together, and explain why you shouldn't light your hair on fire with the rest of everybody else you're seeing on the internet.
This conversation is about financial tools and strategies, how to use them effectively if they become available. This is not an endorsement of any particular economic policy, regulatory approach, or political position. We're here to analyze the mechanics and applications from a wealth-building perspective, not to advocate for or against those proposals.
All right, Daniel, so before we jump into the groundwork and what we need to lay down for people to understand so that when we explain the concepts, it makes more sense about the housing industry, what is it that you're actually hearing on the ground? What are your clients telling you that is causing people to pull their hair out and maybe face that calamity that we're seeing a lot?
Yeah, most commonly, which I'm sure you're seeing online too, is that you're gonna pay double, if not more, in interest, and also that you're not going to have any equity to perhaps move into another property that you wanna buy in the future or into an investment property, and it just doesn't make sense for most people to want to be strapped to their mortgage that way.
Yeah, absolutely. And again, these fears are not irrational. We're trying to show people how we can take a situation and maybe position it better for them or use a tool better so that it turns what might feel like this calamity into something that becomes an asset for their wealth or their building of equity over the long term, not just in the house, but in other spaces. So with that, let's kind of jump into the groundwork and then explain how these situations play out for them. That sound good?
Perfect.
All right, awesome. What do we need to know about the industry to kind of really fundamentally understand where we're starting this conversation? Because most of the calamity comes through the concept of 50 years of interest. That's a ton of money, and that's true. It is a ton of money. But do people actually make it that far? Let's take a look at the notes. As you can see by my terrible penmanship, right now, when you're looking at when the 30-year mortgage came into place, which was between 1940 and 1960, it actually increased home ownership by about 18.3%, right? But the market sentiment was very similar to what we're seeing today with the 50-year mortgage, because before that it was between, I think it was like 5 to 11 years and 50% down payments. If we saw that today, you'd see calamity around that consideration and moving back to those positions overall.
Because almost nobody could put 50% down today.
So the idea was, let's increase home ownership. Well, it did that. So if we're looking at the 50-year mortgage and why the administration might be considering something like that, I'm willing to bet they're looking at history and saying, maybe that's possible. What we've also seen is that the 30-year mortgage hasn't ruined the housing market. But what does this look like today? So as you can see by my lovely blue penmanship, didn't get better between black and blue, 90% of the mortgages today are 30-year mortgages because people want what? Lowest payments. That's all they care about. When people come to you, how many people say, how much can I afford?
It is exactly the answer every single time. Right. What is my payment going to be?
Does anybody ask you how much interest I'm going to pay?
No.
They maybe consider like my rate is higher than I like it to be, but they're not doing the amortization. How many people do you think actually look at amortization tables?
Very few.
Do you look at them all?
Analytics do, that type of personality, but that's very few. And they already know what they're getting into as well.
You didn't have to say my name, but I knew who you were talking about. All right, so then how many of those people reach maturity? Like on those 30-year mortgages, we know 90% of them are 30 years. Well, only 12 to 15% ever reach maturity, which means nobody is paying 30 years of interest. It's just not happening. So the consideration that that wouldn't carry over also to a 50-year, we might want to take a step back and breathe and say, okay, well, what does that mean? How does that happen? Why are people not reaching maturity? And first-time homebuyers, the statistic today is that first-time homebuyers typically refi within 4 years, right? So that's part of the way those 30-year mortgages don't make it there. Now, there are arguments around you've just restarted your interest cycle and things like that, but people aren't paying attention to that. And what you've noticed is that home ownership is still a large key in terms of net worth or accumulating wealth and those kind of considerations, because there's more things to it than the interest alone. So then we need to consider, well, how do houses make money? Is it just the equity you build in your payments? What would you say, and I know I have it written here, but houses appreciate over time. That's the big reason people like a house as an asset is you can't make more land, so those prices go up. Average number is about 3 to 5% depending on where you live. Which means that without doing anything, just sitting on that, you're going to make 3 to 5% per year on the value of your home. Now with those small payments, we need to reconsider what that looks like as you're making your payments on a 50-year. How does this really turn out in the long run? And how do those things play out in reality? So we're going to talk about some real client situations. Daniel's going to kind of walk through maybe some of the situations and things he's heard. And we're going to have a conversation about what strategies might work on top of this to actually reposition the 50-year in your advantage and not in the bank's. So biggest thing we want to start with is people's idea that like this interest is overwhelmingly expensive, or like it's some anomaly that they'll never have to face if they don't do a 50-year mortgage, right? Because what is the one thing we know? People need a place to live. That isn't changing. Like for anybody out there, unless you're moving up to San Francisco, there's some spots on the street. We won't get into that.
Which have their costs as well.
They do. Just not to you typically. Anyway, if you remember, like in order to live in a house, you're either going to rent or you're going to buy. Those are the two considerations you need to look at. So let's just do an apples to apples comparison of a 50-year mortgage on a $360,000 home, and that's going to give us our mortgage payment.
Why $363,000?
That's the average cost of a home across the entire United States.
Yes.
Falls right about the median number. And so we need to also look at what is the median increase on rent year over year across the United States. Well, that's about 3.5%. So let's compare how these two things play out. Year one, you're starting both at $1,793. That is your monthly payment. No matter what you do, you've got to pay that for rent. You got to pay that for your mortgage, right? So everybody understands that concept. Well, year 20, that payment is now $3,567. Year 20 on the 50-year mortgage, it's $1,793. Year 35, $6,027. Year 35, $1,793. Year 50, $10,013, $1,793 on the 50-year mortgage. And what we need to pay attention to now is that total over 50 years. How much did I pay to live? Because we have to live in a house. Well, $5,097,636 total for your rent cost. That went to who?
Your landlord.
Your landlord. Who owns what?
The property.
Yes. So
who's building?
He might have a what? 50-year mortgage. He doesn't care. You're paying for it. He doesn't care about the interest. That's free money to him because you're building his equity at whatever pace it costs, but maybe it lowers his cost of living as well. So now let's look at you. Okay, so we own this, flat payments across 50 years. What that essentially is at its worst is a locked-in fixed housing price, even if you consider it rent. But there's a big difference at the end. So if we know renting costs you $5 million, what's our total with interest? Well, on a $360,000 house, yes, you pay over $800,000 in interest. Calamity. Until you compare it to what your rental cost would have been, right?
That's where the real calamity should be.
Correct. So now we're looking at a positive net worth of almost $4 million back in your pocket, right? Even with all the interest you paid to the bank. Great, the bank won, but you also win. Now we also need to consider there's a $2 million house, because if you increase your house price by 3.5% over 50 years, you're just over $2 million in home equity that you have just paid off with your 50-year mortgage. Now, what that really means is there's a $6 million net worth difference between renting and owning. That's the part people are missing. Don't worry about what you're paying the bank. That's the cost of doing business unless you have cash to go pay for the house yourself. Is that a lot of money? Nobody's arguing it isn't. But what we're arguing is in the long run, if you have a strategy and a consideration, it's always going to win out even if you have to pay a ton of interest. It may not feel fun. It may feel like the bank does own you, and maybe in some aspects they do for 50 years, but that's not the consideration. The consideration is what position does it put me in to use a tool, right? So this is just apples to apples. Is there anything you want to?
Let's add one more rather simple example. For this next example, very simple. Let's just say you are going to rent or buy. And in either case, the rent never goes up. Over 50 years, it remains the same. And let's pretend for a moment that in the owning situation, your value never increases. Ridiculous assumption, but let's just pretend. The value today of $363,000 is what it is at the end of 50 years. What do you have at the end of renting at this property for 50 years? You have a box of receipts. As opposed to, you now have a 50-year matured mortgage, right? So you own this home that is valued at $363,000. Forget about all the interest and whatnot paid. You at least have an asset worth something at the end.
Correct. Let's do this. All right, so let's get into some more intricate scenarios. What are some of the things that you see if people, say you had a customer who was coming to you and considering a 30-year or a 50-year, Let's talk a little bit about what those differences today would be, right? Maybe you have a client who can afford a 30-year, right? But they're like, well, what about this 50-year? It can drop my payment, right? So let's use the same example we've been using of that $363,000 home, right? So our house up here is still $363,000, right? With the down payment of like that 13%, which was 47-ish. Okay, so that would bring their loan value to, where did my sheet go? I just want to make sure I got this math right. Right, so those are our considerations on this. And now we want to say, what are the differences between the 30 and the 50? How do I pick one or the other? Why would a 50-year ever make sense to me if knowing the interest is going to be more than the 30? I mean, if really that's your consideration, why are we not going on a 15? Flat out, like if it's an interest problem, then the 15, if that is your main goal, the 15 is the goal. But if your main goal is to say, how does this fit well in my wealth strategy or my home buying strategy, whatever financial planning you've done, well, then there's considerations to use the tool. So let's talk about it. What we know right now is that a 15-year mortgage has a lower interest rate than a 30-year mortgage, correct? And
Yes.
then hypothetically, we can extrapolate to say that a 50-year mortgage is going to have a higher interest rate than a 30-year mortgage, correct?
Correct.
In order to get the estimated 50-year rate, we just basically looked at the 15-year, the 30-year, what's the distance between those, and then we extrapolated that or made it an estimate for that 50-year. So that's how we came up with the math. It could be different. It may be the same. Who knows what they do with it? This is still exploratory, but for our illustrations, that's how we're going to create the 6.9%. On a 30-year, your mortgage is $1,920. On a 50-year, it's $1,793 given the interest rates given, right? So what we can say there is that there is a net savings on this side of 100. What did we say it was? 127? Yes. $127 a month that you save in the month. And people are going to look at this and go, what good is that for me? Why?
That's significant. That's eating out like twice.
Correct.
In California.
Correct. But that's where most people stop the thinking. They're not saying, well, what is this $127 doing for me? One, if your budget is that tight, maybe the consideration is we can't afford a home. But what we know is there's qualifications to buy a home. If your DTI is separated by $127, are they able to qualify for that home?
DTI, to be clear, is debt to income. It's a ratio, yes.
Yeah, so your debt to income, that number has to be under right around 47%, I think, at the highest.
Yep.
Normally, a $127 difference is going to set you to an unqualified position. So if we're that tight on the budget, it's likely that we can't buy a home in the first place. But if I can create that much space, and I know I can afford the higher payment, well, how do I weaponize this dollar value now? Seems insignificant, but we know we have a 50-year time span to really consider the math.
So we have 50 years to play with $127 every single month.
Correct. That's the theory, right?
Okay.
Now, $127 a month could also be a family meal. It could be a bunch of things that you prioritize, right? But let's talk about it from a financial planning standpoint and what that can do. So we're going to clear our board here. And we're going to talk some other rough numbers on what we call arbitrage. Arbitrage is, we know it's going to cost us money on the mortgage. So we know that the mortgage is going to cost us some percentage of interest. Arbitrage is, how do we take that interest and beat it with the savings somewhere else and grow our interest coming back to our pocket faster than what we're losing in the cost to borrow that money, right? So we know right now we have $127 per month to do something with. We also know that the benchmark for the stock market, anybody know? Bueller?
10%?
S&P 500 at roughly 10% per year. So that's the average growth that we see on the S&P 500 year over year. The S&P 500 is the top 500 companies in the United States. And on average, that 10% is what they grow. So we know that our mortgage rate is 6.9%. So if you do the math between those, right, you get a 3.1% growth potential on that $127 just by simply sticking here. Well, what does that look like over 50 years, right? So our actual math on that would be a total of, put this in green so we all know it's good.
What is that? Is that about 700 months?
Yeah, something like that, 700 months. So your investment into the stock market over that time would be $76,200.
That's $127 times 700 months.
Correct. Okay. Now our gains at 10% year over year would be 2,198 0.063. And if you remember from our other example, right, where we talked about what the interest on that house would be, we are looking at a total of about 1.1 million on a $363,000 house. So we look at that, and that's roughly 700, and let's just call it rounded off, 40K in interest. So if in the market we end up at this number, we subtract out our original investment, that leaves us with a difference of 2,121 and 863, which means that if you subtract out the interest from this, we were able to produce $1.4 million rough net average back into your pocket, just simply taking that money and sticking it right into the investment account that you have for your family.
And this also assumes that we are actually paying this 50-year mortgage to maturity, but we are reinvesting the portion that we're saving on the 50 years.
This doesn't consider other financial strategies underneath that say, maybe I refi when the rates drop. Maybe I refi cash out and I'm going to take a lump sum and add it to this account. Maybe I need to pay off other debts with that cash out refi. The number one problem we see with a lot of people is they have house equity, but it's illiquid, meaning they can't touch it, they can't use it. And your house, while it's appreciating, is growing slower than the 10% in the market rate, right? So that arbitrage allows us, with a financial professional, most times, to sit there and say, well, how do I take every dollar and position it? The name of the game for wealth accumulation is very rarely, I need to make more money. I need to make my money work better for me is typically the answer. That means more tax efficient, right? And other considerations around how I position every dollar in my budget.
Yeah.
I've just shown you how $127 can equal millions of dollars over 50 years. Well, most people's work history tends to be about half of that. Well, even if we came up with half of that time frame and we're just putting 127, even if it has nothing related to your house, there's some powerful tools that people just overlook just on basic math.
And this example right here is, like, to his point, is not even touching the equity. This is just touching the small savings from you deciding on a 50-year versus a 30-year.
Correct.
Which again is not going to be for everybody. This 50-year option is an opportunity for some people that want to get into a home, but really that $127 means a lot to them and they need it.
Yeah, and then you're considering you still have a $2 million home if it's growing at 3.5% at the end of it paid off in cash. So your net worth will now be your investment account plus this. You don't even care about this number anymore. Who cares what the bank made? What people don't understand is this isn't a lump sum game. It's not the bank wins or you win. If everybody's winning across the board, then we need to stop looking at it at simple math and simple emotional responses to that math. Now, again, it's not a one-size-fits all. It depends on your ability to stay accountable to that plan and that strategy, because that's where the butter is put on the bread, right? Like if we, I don't know what that analogy was. That wasn't even an analogy. That's where, what is the phrase I'm looking for?
I have no idea.
That is where the what is made. That is where the what is in my head. That's where the proof is, like, that's where
Proof is in the pudding?
Proof is in the pudding. Proof is in the pudding.
The butter's on the bread?
The accountability, what is it, what I want to, anyway. You know what I'm trying to say, right? I'm trying to say that it takes work to get there and it takes a strategy to get there, but more importantly, it takes you doing the strategy or enacting that plan to get to the end goal.
Okay, so there's tax benefits to owning a home. You have the security of knowing that you're going to have somewhere to live and that your landlord is not going to decide to sell the home. And that means that you're going to have to move. And there are costs associated with moving, as you may know. Community attachment, we're very proud of the place that we live. We have people where I live, my direct neighbors, who literally help care for my son, for my kids. They have a direct emotional attachment to us. It's beautiful. We know too that if somebody who doesn't belong at our home is there, one of our neighbors will see and let us know. It's nice to know that you have that. Could you get that with renting? Sure, but your stay is likely going to be limited, and so you're going to be relocating constantly. And then options, Many times my clients want to purchase a home and they have aspirations to start an investment portfolio where they have rental property. Passive income is the name of the game that everybody's so interested in today. Well, your first home that you buy may end up being the first property that you decide to rent out, whether it be a long-term rental, an Airbnb. There's many different options, and you don't get that when you are renting.
Correct. And one thing we really want to point out is what's in purple. So there's no one-size-fits-all solution for everybody. It really comes down to, do you understand as a family what your goals are with that house? If the house is just a place to live and have security, great, it can solve that. If it's to build wealth and use it as an asset, great, we can solve that. But ultimately, you dictate what that goal is, and your adherence to those goals are what tell you what tools to use. And so that's kind of what we want to really impress upon you. We're not saying that everybody should get involved in a 50-year mortgage by any means. But what we're saying is it's a consideration to look at and say, if I use that tool, how beneficial could it be? What other tools are out there? What works better? And then what of those align with my goals to build that strategy out? Ultimately, talk with your professionals, talk with your team. And if your team isn't talking to you about strategy, then they're just doing and checking the boxes of their job. They're not actually considering, how do I put you in the best position with the thing that you're trying to do, whether that's buying a house, whether that's financial planning, whether that's buying a car.
Even renting a house. We should also say that buying is not right for everybody. Your stay may be quite temporary, and so you can't be tied down. Renting is going to be the best option for you in that case.
100%. Well,
you need a plan.
I think the best way to wrap this is to say this is going to be the first of many conversations I think you and I are going to have. I hope you guys appreciate our personalities that are probably going to come through these things while trying to have what is normally a mundane conversation about nerdy math and considerations of long-term strategy and the things that most people don't want to talk about because they're boring. We're going to try to spice that up a little bit by just being us. But
so also, link to our OnlyFans is below.
Yes, where we sell real estate.
Yes, and financial
We figured people
advice.
were making money there, so we'd open our own shop.
Yes. If you'd like to open your first 401k, sign up for our OnlyFans.
Yeah, that's the way it goes. Other than that, guys, check out our information. There'll be more information attached to some other strategies you guys can review, attached in some links below. If you guys have suggestions for what you want to hear about in these places, whether it's just questions generally, whether it's ideas you've thought about, we have some things that are going to be upcoming, especially now that the Trump administration yesterday talked about portable and assumable loans. That's going to be another piece, but we're open. We want to hear what you guys want to know. We're going to talk about it. You can believe us. You don't have to. You can be angry. You don't have to. Again, we're all about options. This video is for educational purposes only and does not constitute financial, investment, or legal advice. The mortgage products discussed are proposals under regulatory evaluation and are not currently available. All examples used hypothetical scenarios with assumed rates of return. Actual results will vary significantly based on individual circumstances and market conditions. Before making any mortgage or financial decisions, consult with qualified professionals who understand your specific situation. This content does not create a client-advisor relationship, and we assume no liability for decisions made based on this information.